Alrighty, so bloody day in the markets today, nonetheless. We're going to go over the fundamental backdrop. We're going to talk about, since we are now at the end of the week, we're going to discuss and talk about what we were looking at as our risk off scenario for the week days in advance. Just always showing you all that now, fast forward to real time. We stay ahead of the curve. Nobody should be confused if you read thoroughly through the risk off scenario that we had highlighted at the beginning of the week on the 16th of November, which was, I believe, on Sunday. This is our Sunday report. And we're seeing the exact scenarios unfold that we discussed and talked about in this report. So we're going to briefly touch on that today. Let me just make sure that my microphone is okay. We're going to take a look at some price action levels that we were previously anticipating that I gave out to you guys publicly that have now been met, just kind of showing you guys that now is not the time to dabble with anybody in this space that has a lack of understanding of institutional order flow, deltas, dark pool information, the retail crowd, right? We had a couple of different fallouts this week with different influencers that clearly have no credentials speaking on technical analysis. This is a Zach Rector's post, and I gotta call this stuff out. It literally is like in my heart to just wake people up and get them to see that these dudes have no idea what they're talking about, right? 11/2/2025, he mentioned to everybody that this is the final buying opportunity before the November rally, right? Whereas in this community, we pay attention to institutional insights. We're patient. We wait for price to come to us, and we react once these levels and targets are met via our institutional data. And so, sure enough, the first executional orders on XRP that I'd personally taken at $2.06 were slightly in profit. Price has now come down, and it does seem like we might see a price drop down into $1.90 under the fundamental backdrop. Especially tomorrow, we have some more economic data to be on the lookout for, which we'll go over here in just 1 second. All right. But again, this is just to show you guys that now is the time to be locked in. Now's the time to make sure that you all are staying adaptable. You guys are making sure that you're reading through the fundamental reports because they all play a very important role throughout the entirety of the week to keep you guys updated and in the loop. So first, taking a look back at our November 16th report, what did we say? For our risk-off scenario, we mentioned a risk-off mood would likely take hold if we see an overall hawkish-leaning Fed, especially in the meeting in minutes, and if this week's data shows the economy is running too hot, or if inflation remains stubborn. If weekly ADP job creation jumps, unemployment drops, or the labor market still looks resilient, the Fed will see no urgency to cut rates, and the market will assume there won't be a December rate cut. That alone could trigger more sideways price action, or worse, more selling. We also talked about down here, in that case, December and 2026 rate cut odds would fall even further. Markets would likely price in that financial conditions will stay tight, and risk assets like crypto and tech would almost certainly see no extreme bullish recovery or even more downside as investors rotate into defensive mode. So now fast forward to today, what does the landscape look like? Hopefully you guys have read the report from today. So reading thoroughly through this for you guys, you can see the total cryptocurrency market cap as of time of recording is down over $100 billion. Today's market was another reminder that crypto does not move in a vacuum. It breathes with macro policy, labor data, and expectations around future liquidity conditions. And unfortunately for risk assets, almost every major data point that hit today leaned in the exact direction that we've been warning about in our previous weekly reports. Stronger labor data, a more hawkish Federal Reserve tone, and a firming US dollar. Together, they cut the legs out from underneath any meaningful risk-on recovery. As a result, the total cryptocurrency market cap shed another $100 billion in value, extending the month-long downtrend. A labor report that complicated the narrative. First, taking a look at today's labor data. The delayed September labor report finally landed, and while the numbers were mixed, the market interpreted them as net hawkish. Non-farm payrolls jumped 119,000, which was more than double the 50K expectation, and a dramatic reversal from August's revised negative 4K print. Even though unemployment ticked up to 4.4%, it's still well below the Fed's own 4.5% projection for 2025, which means that the labor market is cooling, but not cooling fast enough to justify immediate easing. Wage growth softened to 0.2% month over month and 3.8% year over year, which normally would ease some inflationary concerns. But with no October jobs report due to the BLS combining October and November into a single December 16 release, this is important. Highlight that date. Today's number carries extra weight ahead of the December 9th through 10th FOMC meeting. When data is delayed, markets cling harder to what is available and right now, and that data is not screaming immediate rate cuts. Crypto thrives, we know, when liquidity conditions are expected to rise. Rate cuts increase liquidity, but when labor remains too firm, the Fed cannot comfortably ease, and today the market recalibrated that uncomfortable reality. Even though the CME Fed Watch tool now shows a 39% odd of a December rate cut, which is up slightly from yesterday, the odds are still meaningfully lower than a near 50% that we saw just about a week ago. And after yesterday's FOMC meeting in minutes revealed that many participants were leaning against a cut in December, the market got the message that the bar for easing still remains high. Morgan Stanley has also now gone as far as removing a December cut from their baseline forecast altogether. The tightening of expectations is exactly what risk assets did not want to see this week, which we highlighted at the beginning of the week for our risk off scenario and in our Zoom call on Sunday. On top of that, we had hawkish Fed rhetoric that put even more pressure on the markets. Labor data alone did not bring the sell-off. Fed officials also added fuel to the fire. We had Fed Goolsbee, Fed Barr, and Fed Hammock all mention hawkish rhetoric today. Cleveland Fed President Beth Hammock made it clear that she believes that easing too soon would encourage excessive financial risk-taking, warning directly that cutting rates risks prolonging higher inflation. She also noted that financial conditions are already quite accommodative, which is a code for we don't need to add more liquidity right now. Fed Governor Michael Barr, doubled down, saying that he remains concerned that inflation is still hovering around 3%, well above the Fed's 2% target. Barr has a known pragmatic streak, so when he leans hawkish, markets listen. All of this shifted the narrative away from the Fed might help us in December to the Fed is likely to stay restrictive for a prolonged period of time. For crypto, which relies heavily on liquidity cycles, this is all seen as bearish pressure. A strong labor print paired with the hawkish Fed is the perfect recipe for a stronger dollar, which we saw today, and that is exactly what happened. The USD rallied broadly, putting downward pressure on assets priced in dollars, including Bitcoin and the broader crypto market. When the dollar strengthens, we know that global liquidity tightens, risk assets lose demand, and emerging markets and crypto take the brunt of it. We've highlighted this in multiple weekly reports. A firmer dollar was one of the worst case scenarios for crypto sentiment. So what does this mean for now? Crypto sell-off was not random. It followed the macro script. We had stronger NFP pushing back the rate cut urgency, still tight labor market figures stating that inflation risks are still alive, hawkish Fed speakers reinforcing a higher for longer environment, stronger United States dollar equaling tighter liquidity conditions for a prolonged period of time, and low rate cut probabilities putting pressure on risk assets. As mentioned, we've been mapping out the risk in our weekly reports. The worst case scenario for November was always going to be stronger labor data, a dollar rebound, and any hawkish Fed language. Today, all three of those scenarios hit at once. Looking ahead, we have the December 9th through 10th Fed meeting. We have December 16th, the NFP release, combined October and November reports. And then obviously, of course, we have any ongoing Fed speakers and commentary in the coming days ahead. What's really going to be important is how the market starts to price in as we roll into more data in December, rate cuts in 2026. On top of that, keep in mind in previous reports, we also went over the Bank of Japan monetary policy that if they did decide to aggressively hike rates and it led to yen strengthening, we could see conditions where yen carry trades unwind, and that is most likely going to be net negative for risk assets, regardless of what all these influencers say on the internet. It is most likely going to lead to more sell pressure in the digital asset ecosystem. So be prepared for that if it were to unfold at a rapid pace. Hopefully, they have measures in place to where they ease any liquidity shocks that could unfold due to a Bank of Japan or Japanese finance minister intervention with the currency. Nonetheless, just keep in mind it could put sell pressure on risk assets. Another thing that I'm being very tentative to, as I saw some headlines between Japan and Taiwan conflicts. I believe there's some intermingle between China and Japan right now around some trade agreements, and there's some, headline escalations around Taiwan, China, and Japan. Just understand that if those things escalate, creating geopolitical uncertainty, that could definitely lead to more demand for safe haven assets, especially as we head into the weekend, and obviously, of course, weigh on risk sentiment. And the last thing outside of those two that I'm paying attention to is the ongoing debacle and outcome of Trump's tariffs with Congress. So for now, crypto will remain sensitive to any shift in the rate cut probability. If labor softens in December or inflation convincingly trends lower, risk assets could stabilize and rebuild. But for now, markets are adjusting to the reality that the Fed is not in a rush to bring rates down and liquidity will stay constrained. This is a challenging environment, but it is not the end of the story. It is a reminder that the macro still drives the bus, and as always, we will always continue to track the deltas between expectations and reality because that is where opportunity lives. So hopefully you guys have taken advantage of these discounts. You guys have taken advantage of our realistic expectations of the market, and hopefully none of you guys are confused as to why we're seeing a complete slaughtering of risk sentiment as of this week. That is likely to continue until these conditions change. So, real fast, just taking a look via the forward outlook for the remainder of this week. We have multiple Fed speakers scattered throughout the day tomorrow in the morning half of New York session. We have the flash PMI figures on the forefront, which as of right now are set to show some signs of slight cooling, still above the 50 grade threshold, showing expansion in the US economy. And then more importantly, we have the revised consumer sentiment and inflation expectations. These are going to be very important tomorrow for us to pay attention to. Outside of that, heading into the weekend, we'll just be mindful of any geopolitical shocks, any tariff-related announcements, any war outbreaks, or anything of that nature that sparks headline risk and a flight to safety. For now, I'm taking advantage of these discounted prices. I've mentioned that to you guys, not financial advice. I have a firm belief that right now there's nothing underlyingly wrong with the crypto infrastructure. It is simply just a risk-off backdrop weighing on overvalued risk assets, especially considering the AI bubble that the stock market is facing up against right now, so on and so forth, and everybody highly anticipating rate cuts in December. And now that is not happening, most likely, unless by some godly outcome, we were to see some type of data report that comes out between now and the December 9th through 10th meeting that improves the probability of that taking place. I highly doubt it. They're most likely to hold rates and deliver hawkish forward guidance, signaling that they're going to remain on hold until they see data that supports an environment to continue easing monetary policy. That is the current fundamental backdrop right now. I just wanted to simply update you guys briefly on that. Nothing too outrageous. Taking a look at the total cryptocurrency market cap real quick. We had mentioned, oh, dang it, I hate when my deltas go away. Taking a look at the higher time frame in previous videos, we had talked about this being our first area of interest where the market makers could push price down into and sweep out over leveraged buy positions. That is currently taking place as we speak. The next area of interest is going to be this deeper retracement area at about 2.5 to 2.6 trillion dollars, taking a fib from that low all the way up to the high. 79% discount of that full-on bullish move from roughly around April lows to the 2025 highs will put us at about $2.7 trillion. So that will be the next key area of interest if this market continues to go lower. If we break below the $2.7 trillion, be prepared for a sweep of liquidity underneath of these over-leveraged buy positions at about $2.3 trillion. I would not be surprised if that unfolded. So next two areas of interest are going to be 2.7 if the market dump continues. And underneath of that, 2.2 to 2.3 trillion dollars. Over on XRP, levels have not changed since most recent updates. I recently bought some XRP at $2.06 under the impression that even if the market was set to go lower, we are still at a very heavily discounted price from 2025 highs at about $3.67. My next area of interest to dollar cost average into some XRP positions are going to be $1.90 and $1.56. That has not changed. Taking a look over, don't forget that I updated you guys and created the metal and XPR delta section so that way you guys can start to chat about analysis on metal and XPR. I'm heavily focused on accumulating more metal this year. I've surpassed 100,000 units of metal. I want to try to get to 150,000. That would be awesome before the year end. You can see right now we are currently hovering at around that 18-cent delta. The next one underneath of that is going to be the 11-cent area of interest, where I would definitely start to accumulate some more metal if we were to get those levels. Mind you, at the end of the day, we're still heavily discounted right now, trading at around 18 to 19 cents. Outside of that, I'm still facilitating some good dollar cost average positions across the board in my portfolio, specifically just focusing on assets that I can stake, earn yield on, provide liquidity with. So I'm heavily focused right now on like Aptos, Red, heavily focused on HBAR and XLM, getting those assets to work over on the MetalX lending platform, right? On loan protocol. But outside of that, guys and gals, the landscape is pretty dry right now outside of what I just broke down. Still just paying attention to any updates on regulatory clarity that could come into fruition and spark a recovery rally. For now, that landscape is relatively dry on the headline spectrum. But outside of that, that's all that I have for you guys. I will leave the floor open for questions if you guys have any commentary. Make sure that you guys are utilizing each of these sections in the Discord to enlighten yourself. The researchers have dropped so many freaking panel discussions from like large financial institutions. This was a really great one I listened to, this rising the current market environment. This dude right here from Signum, literally word for word, everything that I just said to you guys is in this call right here. Talks about the backdrop being risk off temporarily, how the market was not expecting that backdrop because they overpriced in rate cut expectations and central bank liquidity easing. Markets got ahead of themselves. They're scaling that back. Institutions are still on board to aggressively enter into this space heading into the new year. Like nothing has changed. So make sure you guys are educating yourself. But outside of that, that's all that I have for you guys for today's update.